Joining me now, Ron Santella, CEO and CIO of Equable Shares. Ron, thanks so much for being here.
Caroline, thanks for having me today. I'm happy to be here.
Well, happy to have you. We are nearing the finish line for 2025. How would you describe current equity market conditions right now, Ron?
I think it's really been an extraordinary time, Caroline, when you think about it, right? The S&P has annualized about 11% since 1970, but as of today, it's up over 23% a year for the last 3 years. We're now at the end of our third great year in the market. So I think for equity investors, they've been rewarded for being patient, and it's a great time to own stocks.
And will it continue to be a great time to own stocks in 2026? Will investors continue to be rewarded? What's your outlook?
So at Equable Shares, we tend to be market agnostic, but we're not market indifferent. We look at what's out there. And I think when one looks at the consensus right now, most conditions are favorable for the equity markets. We're entering 2026 with consensus forecast being double-digit growth for the S&P 500. Of course, earnings are the primary driver of stock prices. Monetary policy is likely to continue to be accommodative, and with a new Fed chair coming in 2026, that probably won't change. I think fiscal policy will continue to be a tailwind for the markets. Expectations are that tax refunds will be greater than expected early in the year. And of course, the one big beautiful bill I think is generally favorable because corporate taxes are likely to go down next year. And the AI trade seems to be real. I mean, there's a substantial amount of CapEx. So look at it from that light. I think the stage is set for 2026 to perhaps continue what's been going on for the last 3 years in the market.
Well, you mentioned a whole lot of tailwinds there, with the S&P 500 up 17% in 2025 and really only 1.5 trading sessions to go here. Would you say that investors are underestimating risk or overthinking it at this point? And what is the biggest risk?
Yeah, I think it's a great question. And I think it's easy to point to all the favorable conditions for the market. By definition, the biggest risk is usually the one you don't see coming. That's why one is surprised, right? But it wasn't that long ago. If you just rewind back to Q1 of this year, the market was down over 4% in the first quarter. We had a period there in April when we were down over 19% in less than 10 trading days. And so we still live in a world where there's geopolitical risk out there. There is still inflation that could linger. It looks benign right now, but if inflation ticks up, that could be a factor for the market. And of course, there's no guarantee earnings hit their mark. So there's always risk in the market, and one should be mindful of that.
Okay, so on that note, is volatility something investors should really just plan for, or is it something that they should fear?
I think the important part of that, what's embedded in that question, is one's time horizon. I think trying to time markets is tricky, but patient investors normally view volatility as their friend. If you can keep a level head through those periods, sometimes they're buying opportunities. They're a time to perhaps shift your portfolio a little bit. So, generally, I think if one is a long-term holder of stocks, volatility should not be viewed as an obstacle. But I think if one is timing the market or riding trends, volatility can, of course, create some uncertainty for those type of investors in any environment.
Okay, so this, of course, is ETF Spotlight. We're spotlighting your Equable Shares Hedged Equity ETF, HEDG, Hedge, which is a hedged options-based strategy. What problem is Hedge designed to solve? What type of investors should be considering it?
Yeah. So when we designed Hedge, what was important to us is to structure a product that we think would appeal to most investors. And I think part of that is that our strategy is designed to be a sleeve or a part of a portfolio, not an entire portfolio. So when we look at hedge, it really is an all-weather product. We've annualized at double digits over the last 3 years, so you do get market participation. But in those periods when the market is either going sideways or when the market's volatile and has pullbacks, our product and these type of hedge products are going to do normally better than just being exposed to the market without any type of hedge.
So would you say it's a risk management tool then? And I guess what does risk management actually mean in practical terms?
Yeah. Risk management, it's a broad term, right? But I do think it's a really important question to ask and also solve for, because it's certainly easy in these type of markets just to cheer for the stock market, but there will be periods when there are underperformance, when you have down months, down quarters, or a down year like 2022, when we had a significant drop in the equity markets. And I think our product is designed for that purpose, for helping one manage the risk, basically to dial back the volatility in their portfolio. Traditionally, our product, Caroline, has been about 40% of the S&P volatility.
So how much downside protection should investors realistically expect from a strategy like this? And what happens if we have another strong performance in 2026? Can you have downside protection without a trade-off when it comes to returns?
Yeah. There's always trade-offs, right? I mean, when one's invested in any hedged product where you're capping your upside using options, and we're one of those products, you will be making a choice. You will trade off some of your upside in the equity markets to get outperformance or to cushion yourself in a downside market. So just to be a little more specific about that, we've annualized at about 11.7% over the last 3 years. The market's annualized at about twice that rate. So in a strong equity market, we will not participate to that level. On the other hand, this year when the market was down over 4% in Q1, we were down less than 0.5% in that environment. So that gets to your question, the trade-off one is making to have better protection in down markets, but not participating in strong up markets.
But it doesn't sound like, although being market agnostic, you don't necessarily have a market view, but it doesn't sound like 2026 is the year that you think that we might, start seeing some doom.
I've been trading options for 40 years, and I look at the world in views of probability. And so I think just being analytical, if one were to draw just a bell curve of outcomes, I still think the overwhelming majority thinks that 80% for something that's either benign or generally favorable for the equity markets. But going through multiple market cycles since 1985, I always think there's risk lurking out there, and one can't time that risk. So why I think 26 could be a good market, I expect volatility in 2026 personally.
Okay, all right. And we know the market can't go up forever. Ron Santella, CEO and CIO of Equable Shares. Really appreciate your insights. Thanks so much.
Hey, I appreciate you having me today, Caroline. Thank you very much, and Happy New Year to you and your viewers.
Happy New Year to you as well.